Hello and welcome, everyone. My name is Nora Lambrecht, and I work on climate change and particularly on climate-related risks within the ESG division of IDB Invest. And as our conference is kicking off this week in the heart of the Amazon in Manaus, it's really wonderful to see so many of you connected on this basically day zero of knowledge sharing, of training, and of dialogue. Before we get officially started, let me start you all off with a few logistical notes. So this webinar will be in English. However, you can access interpretation with the little globe symbol at the bottom of your Zoom menu. So interpretation for both Spanish and Portuguese is available. You will also see some more instructions on that Valentina Seki kindly posted in the chat. We will also be recording today's session. And last but not least, because we want this to be a dialogue and knowledge sharing, please feel free to share your questions that you might have to our wonderful panel of experts that is here with us today in the chat, and we will do our utmost to answer as many questions as we can in the second part of this session. All right, then without further ado, let's get down to business. And the business today is the climate crisis. So as you all know, the climate crisis is really this very multifaceted issue, and it's many people call it a risk multiplier. And we've seen, particularly in the last few months and years, that it's already affecting people, it's affecting livelihoods, communities, and ultimately the economies in Latin America and the Caribbean and around the globe. But at the same time, change can offer opportunities. So today we want to disentangle some of these complexities, and the session's objective is really about exploring how financial institutions in Latin America and the Caribbean can tackle risks and reap the opportunities that climate change poses. And as I already alluded to, we have some experts here to discuss this with. So first off, we have Mr. Matias Gallardo. He is part of Finance in Motion and responsible for assessing the impact of the investments in green bonds made by LA Green. And since 2013, he's focused on the issuance of thematic bonds through his work in organizations like the IDB, UNEP FI, and also UN Environment. And particularly, Matias is really specialized in the role that capital markets and the financial sector can have in supporting a transition to a more inclusive and low carbon economies. Secondly, we have Ms. Verity Chega. She's been appointed to the International Sustainability Standards Board, the ISSB, in June 2022. And prior to that, she's held a variety of leadership positions on ESG investment, for instance, both at the California State Teachers Retirement System, CalSTRS, and also at BlackRock. She was also appointed as one of the inaugural members of the SASB Standards Board from 2017, and she also served as co-vice chair from 2018 up to 2022 to her most recent appointment. And then thirdly, we're really stuck today. We have Dr. Laura Canevari. She's an accomplished climate change adaptation academic, so focusing more on the adaptation side, and consultant with over 10 years experience in adaptation and resilience building, particularly in small island developing states. She's also the CEO and founder of Ithaca Solutions, and over the past years, she supported the design and provision of climate services for the public and also for the private sector, including development of vulnerability, climate risk assessment, adaptation plans, decision support tools for financial institutions, and a lot more. So those are our wonderful discussants here today. And perhaps to get this discussion going, let me start with a question, Matthias, for you. Can you give us a little bit more of the landscape of what really is the impact of climate change on the financial sector in Latin America and the Caribbean? And can you also tell us a little bit about why climate change is a financial risk?
Sure. Thank you, Nora. And first of all, thanks for inviting me, and it's a pleasure to be in this panel. Um, so you asked me two questions, basically, and let me jump right into the first one and slowly transition into the second one, and transition here is the key word. Um, but if you ask me what the impact of climate change is on the financial sector in Latin America, my personal take is that we don't know yet. We don't know yet how much of an impact climate change has on the financial sector of the region. Furthermore, I don't think we know the impact that climate change is having in the economy of the regions, in the economies of the region. And that is quite important. We have made a lot of progress throughout the years that we all been engaged on sustainable finance and climate risk. We've made quite a lot of progress, and some of the institutions in the region have made quite a lot of progress regarding and trying to understand how it will impact us in the future. But we don't really see, and we have not really measured the impact that it is having currently on the region. And to illustrate my point, let me give you an example. In the last 2 or 3 years, the region has faced several quite out of the ordinary, extraordinary forest fires, large fires that affected several countries at once. Now, we do have measures on agricultural land impacted and production lost and so on. But there's other costs that are related to these catastrophes that we're not sure, and I haven't seen any studies or any measurements of those. And I'm referring to the amount of money or the increase of acute respiratory infections that the public health systems of the countries had to deal with. And that can also translate to cost for health insurers. This also translates for costs for SMEs or for companies because people are sick and are not going, or because kids are sick and are not going. But so we've seen a lot of quantification of the direct impact of climate change and environmental extreme events. But we're not really seeing and we're not really measuring the next steps and the next impact, the following up impacts. And that's what led me to say we're not really sure and we're not really aware of the impact that it has. And the same kind of logic can be applied to the different kind of extreme events, right? Whether it's flooding, whether it's droughts, whether it's hurricanes, we are only quantifying the direct impact that these events have, but not the sort of secondary impacts that these events cause. Now, let me sort of stop here for 1 second and clarify 2 points, because I jump right into this discussion. You're asking me about the impact on the financial sector, and I jump right into this discussion with an example that sort of goes away from this. And the reason why I decided to pick my first example and to address insurance companies is because in Latin America, normally when we say financial system or financial sector, we tend to think automatically in banks. And yes, banks are the largest players in the region. But the financial sector has a multiplicity of other actors that are also affected. Now, the other reason why I chose insurance companies is because insurance companies are inherently created to measure the impact of events that are going to happen in the medium or long term, and how can they mitigate those impacts. If we don't have insurance companies in the region that are actually able to mitigate and to measure and to address these issues and that we're facing already, then the question becomes even more complicated for institutions that are focused on short-term lending. And those are mainly banks, right? The discrepancy between the lending times of the banks is quite well discussed within sustainable finance. And this is quite important because we're asking banks that provide short-term loans to address and to understand how these long-term effects are going to impact their stability, right? So this is quite important. Now, the other thing I've done is jump and move away from looking exclusively at how the financial sector is going to be affected and start talking about the broad economy. And this is quite important because we cannot conceive the financial sector as a standalone sector. We have to think that whatever happens in the real economy, in the real sector of the economy, it is going to affect the financial sector. And it might not affect immediately, but it's going to affect in a second or a third stage, and it will have implications. And that is the level of exposure that our financial institutions are going to have. So it is quite important. And personally, every time I try to address the the exposure and the complications of climate risk for the financial sector, I always try to link it to the impact that it's having on the real sector of the economy, because we cannot do this alone. The financial sector cannot do this alone, and we need the real sector of the economy engaging. Right? Let me give you another very recent example of how this impact can happen. Recently, as last week, I read a news report that the indigenous people from Gunayala, the Gunas in Panama, were being relocated because of sea level rise. Okay, now this might sound something very specific that is happening in one part of the continent to one specific group of people, but the point is the Gunayala communities live from tourism. If they're being relocated from their islands because of the high rise, the sea level rising, this affects their whole livelihoods, and this affects the tourism industry in the region. Now, if you affect tourism in this industry in the region, you're affecting hotels, you're affecting restaurants, you're affecting airlines, transport, buses, crews. So it has a systemic effect on more than just the population that it affected. And again, it's something that is basically ongoing. This is as recent as last week. So again, I feel that the region is ill prepared to understand how climate change is impacting the financial sector, because we don't really understand how climate change is affecting our economies. Now, the whole conception of climate risk is precisely that. Climate change is going to affect us in more than one sector and more than one time, with more than one catastrophe or more than one measure to affect and to impact the financial sector. And normally, and for the average person, when we say climate risk, the first thing that comes to mind are the catastrophes, right? Hurricanes, fires, etc. Those are the physical risks that the economies and the financial sector is focused at. And Laura is probably going to address some of those challenges later on. But the risk that I'm more concerned about is the transition risk, right? Our economies can simply not continue producing the same way they are. We need to start looking at new ways of producing. I'm not saying to stop producing, I'm saying looking at new ways of producing. And the longer we take to do this change of mindset and this change on the production systems, the higher the cost of transition finance is going to be. Now, I don't want to sound pessimistic. There's progress in the region as well. As I said, there's several institutions, there's several companies that had made a lot of progress, that created capacities that help move the agenda forward, and working in a finance in motion in a fund specifically created to invest in green bonds in Latin America. One of the areas where we see some of this sort of news and good news is precisely the issuance of thematic bonds, right? In the last 2-3 years, the issuance of thematic bonds in the region has outgrown the issuance of normal bonds. So this means that despite the global context of contraction and so on, the region is issuing more thematic bonds than is issuing normal bonds. So as capital markets grow, they're growing with more focus on sustainability. So there are some good news. Now, to conclude, one of the biggest challenges that anybody, a company or a financial institution has when they start addressing climate risks and when they start engaging on all this conversation is precisely, where do I start? There is a vast amount of initiatives. There is a vast amount of methodologies, approaches, and focuses that one can take to start addressing this overwhelming problem. Now, luckily, there are new initiatives, and there are initiatives that are trying to streamline and simplify all of these challenges for us and try to make it more comparable and more simple. And that is what I believe Verity is going to address in just a second. So let me wrap up there. Thank you.
Thank you, Matthias, for this and for this nice segue to Verity indeed. So what I'm hearing is really we need the real sector as well. In the end, it's not just the financial institutions themselves, it's the cascading effects that we need to understand. It's not just the banks, but it's the entire financial sector, the entire financial system. And sort of given these complexities, but given also the opportunities that you've addressed, Verity, let me come to you. So the IFRS Foundation, as Matthias just alluded to, has done a lot of wonderful work in terms of clearing up the alphabet soup of all these different sustainability standards that have emerged over the last few years, and also against the backdrop of the complexities of climate risk that Matthias just explained. Can you tell us, as a member of the Internationally Sustainability Standards Board, a little bit how those standards can help companies and financial institutions?
Yeah. Bom dia, buen dia, and good day to all of you. Thank you, Nora, for the invitation, and to IDB. It's wonderful to be here in this virtual conversation, in this virtual room with all of you. And absolutely, you were spot on to translate sort of the description of market interest. I think you very well captured why it matters and why this matters to capital allocators. So the IFRS Foundation, as most people would be familiar with the IFRS Foundation because of the accounting standards body, the International Accounting Standards Board, which sets accounting standards and have been in use for 2 decades, 20 years now, and are legally mandated in more than 140 jurisdictions around the world, these accounting standards. They're very much taken for granted. But as Matthias very well described, there's been this acknowledgement, this realization that additional information is needed to help decisions for investors, lenders, and creditors. And so the IFRS Foundation asked the market, and the resounding answer was yes. IFRS Foundation should embark on setting standards for comparable, decision useful material information to help these investment decisions be able to flow more effectively toward the places where both risk could be mitigated and opportunity could be captured. And so here we are working on creating standards for entities to disclose their sustainability position and performance for an audience specifically that is investors, lenders, and creditors. And I'm just going to use investors for short, but I'm talking about both, if you like, both the buyers of climate bonds and sustainability-linked bonds and green bonds, but also the buyers of traditional bonds for general purpose corporate uses. So the full spectrum of investors, lenders, and allocators. And so they need to know when they're deciding to allocate capital, they need to know about both risk and opportunity, because upside matters just as much. And so this supports the pricing of assets and really helps this capital flow more effectively across regions, including Latin America and the Caribbean. And so we ask in our standards, including our IFRS S2 climate disclosure standard, we ask companies to describe all of the risks and opportunities related to their prospects. So we're not talking about only the information that would describe how the entity affects the environment, but also recognizing that the entity operates within a market context, within a real natural context. It has dependencies on resources. It has relationships with communities and workers and other people who help create this entity's success and help create value within the entity. And so an entity would describe how it manages the resources and relationships, including with natural capital, in order to store value and also grow that value over the long term, which is useful information for investors, lenders, and creditors. Material information is what we focus on providing. And so, Nora, you and Matthias also asked me about this alphabet soup, and so I want to share a few acronyms that describe how we ended up deciding what requirements are in our standards. Overwhelmingly, we heard from the market that the Task Force on Climate-Related Financial Disclosures, or TCFD, is a useful structure, useful for entities in all sectors and in all geographies. It's actually so useful to investors that they think it's useful not only for climate, but for other sustainability-related issues, including human capital and ecological services or nature and other issues. So we two standards, our general requirement standard and our climate standard, on the TCFD architecture. So we have there all of the recognizable elements for those entities who already disclosed to TCFD, the governance of your climate risk and opportunity, your strategy to manage climate as a risk at your entity, your risk management process, and then finally your targets and metrics, which are all helpful to measure the entity's progress over time. Some of the elements that we require companies talk about are cross-sector, so they apply to all companies in all types of businesses and with all business models, including when we ask companies to describe their resilience to climate change. And we do ask entities to use scenario analysis when they assess their resilience to climate change. But it's important to know that we designed our standard to be scalable for companies of all sizes with all levels of resources and staffing. And so even that sort of C-suite sitting down to think about looking ahead to the future, how would our business be impacted by climate? That is sitting down to do a scenario analysis. So other companies might have more staff and resources and expertise that can do really sophisticated quantitative modeling and come up with a really fairly precise amount of money that would be expected to be able to help the entity be resilient to climate change over the next 10 or 15 years. But both can be valuable to investors. And so we allow both a range or a specific amount, and we allow both quantitative and qualitative information to make sure that there's comparable information out there. I also can describe that we have, in addition to cross-sector metrics, we require companies to provide industry-specific information. This is something we heard overwhelmingly is valuable for investors and other lenders and creditors, that they assess individual companies against their global peers in the same industry and activities, banks against banks, for example. And here we have relied on the work of the Sustainability Accounting Standards Board, or SASB. So we provided industry-based guidance that helps companies identify how could they talk about their industry-specific performance or risks in a way that is likely to be material to investors and lenders. And so we provide specific metrics that companies can consider when they're determining their disclosures. So I told you about TCFD, I told you about SASB, but I want to throw out a few others if I can. We also involved into the IFRS Foundation the work of the Climate Disclosure Standards Board, which has been around for a while and actually fed into the creation of the TCFD as well as the SASB did. So that's built in. I also described these resources and relationships, and that sort of content comes directly from the International Integrated Reporting Council, which created the integrated reporting framework that is widely in use across Brazil and many other jurisdictions. Integrated reporting is also built in and is now part of the materials of the IFRS Foundation. So that's TCFD, SASB, CDSB, IR, and then I want to even mention a few more here just to really get the alphabet soup going. The Global Reporting Initiative, or GRI, is another organization that many companies have been using to do sustainability reporting, not only to investors, but to many other stakeholders, including communities, civil society, employees, and others. They have now announced just last month that they will be looking to our own work to respond and set their own technical agenda in response to the ISSB's work. And this is really about harmonizing and bringing a more efficient reporting system to the global capital markets. And then CDP, formerly known as the Climate Disclosure Project, many companies and value chains that sell into brands around the world report their climate risks to CDP. And CDP announced that its 2024 climate questionnaire, or its new combined questionnaire this year, is based on the ISSB's S2 climate standard. So companies that already disclose to CDP are going to get a great practice run to find out the kinds of questions and requirements that are included in the S2. And Nora, I could spend a lot more time, but I want to stop here and see what Laura is going to contribute and then see what kind of conversation we have.
Thank you so much, yeah, for those remarks. And I think it's very clear that we're sort of at this critical point where we're seeing the evolution and a lot of consolidation happening. One thing that also struck me was that you were really focusing on the fact that this is decision useful information in order to allocate capital that needs to be generated and in the end digested, right? So let me sort of use this point to ask you, Laura. How do you generate that information and how do you digest it? So with your background of having worked with so many institutions on climate change, advising them particularly on the physical impacts and on building resilience, how do you disclose, how do you measure, how do you manage? Just a small question for you.
Thank you, Nora. And as you mentioned, I'm the CEO and founder of Ithaca Solutions. We are a climate technical assistance service provider registered in Panama, and we're currently operating in Central America, in Colombia, and the Caribbean. But for the past 15 years of my life, I have been dedicated really to understanding how to manage physical climate risks, how to adapt to climate change, and how to build successful strategies for climate compatible development, with a particular focus on the private sector and private sector adaptation. So in that time, I've had the opportunity to support financial institutions in Latin America on their climate journey, working with commercial banks, bank associations, microfinancing facilities, multilateral and national development banks in countries like Colombia, Mexico, Honduras, Brazil, Bolivia. And in particularly, I've been helping advise to identify physical climate risks in their portfolio with their objective of not only finding ways to reduce those risks, but also to tap into emerging investment opportunities. So let's start with an example. Like, let's assume that for a second, you manage a portfolio of investments in the agriculture sector within a region in Latin America that is more frequently affected by extreme climate events like droughts and floods. So in practice, you now have a portfolio that is highly exposed to the impacts of climate change. Your operation is at risk because the negative impacts of climate change happening on the ground to the operations that you invest in will be transferred to the portfolio as credit risk, operational risk, legal liabilities, and potential reputational loss. So should you be changing your portfolio of investments? Should you be changing your clients, the region where you operate? Or should you be finding ways to bring to these clients innovative solutions to climate-proof their operations and reduce their risk of failure due to climate phenomena? Or should you be helping them transition to other activities? The answer is complex. It actually depends, and it is a case-by-case decision to be taken. But one of the key things that I have learned from guiding FIs through this type of decisions, and which I invite all of you to embrace, is that the entry point to tap into investment opportunities lies in understanding and characterizing thoroughly the climate risks. In other words, the better we understand how the climate is having an impact on natural resources, on operations, and on the broader economy, the more value we are going to get from climate action and from climate investments. And the easier it will be to link investments to the different criteria set out in sustainable finance taxonomies, especially when it comes to adaptation taxonomies. But in order to capitalize on the emerging investment opportunity, and I'd just like to stress, Nora, it is a major investment opportunity. For those of you who do not know this, the current adaptation finance gap, as estimated by UNEP at the end of last year, is at around 190 to 366 US billion per year. That is how much we need in order to remain in a climate-compatible development pathway globally. Now, for LAC, fulfilling climate action commitments requires, according to ECLAC, an investment of around 3 to 5% of GDP per year until 2030, regional GDP, and that is both for adaptation and mitigation, however. Now, by comparison, climate finance in Latin America and the Caribbean in 2020 was just around 0.5% of regional GDP. So to close the climate financing gap, it requires internal, domestic, and international resource mobilization of about 7 to 10 times what it is currently. So to capitalize on this emerging investment opportunity, as I'm saying, there must be a change in the mindset of the investor, because, and this is close to what Matthias was saying at the beginning, really the world that we are creating, the world that we need to create given the magnitude of current climate hazards, is not the world in which we live in. A climate resilient world requires a longer term view on investment. It requires familiarization with the risk profile and the business case of innovative solutions and products. And I would say, most importantly, the decision-making process of the investor or the lender or the insurer, the decision-making process our world needs must be aligning the financial opportunity with the positive climate impact. In other words, investments must support progress on national adaptation plans, on nationally determined contributions, and they must contribute to reducing climate risks whilst producing other societal and environmental benefits. So I'd love to get to know where you think you are on this journey. So just ask yourselves a couple of questions. The first is, do you know what are the climate hazards or climate threats that your business or your investments are exposed to? Second, do you understand the climate risk profiles of the locations where you operate or you invest in? And finally, can you name the type of adaptation measures that your activities must embrace to be climate proof and to meet their expected financial returns under a changing climate? And if you do not know the answer to one or more of these questions, that is okay. You may want to ask other people in your organizations. But if you're still not finding the answer, then you must acknowledge that you may have a knowledge gap within your organization. And you must ask yourself whether you can, in today's world, plan strategically to remain competitive without this type of information or knowledge driving your decisions and your portfolio management. So I think the main message I'm trying to convey here is that addressing climate risks and opportunities is not just a matter of best practice and aligning to best practice internationally. It is really at the core of business survival. And I'll leave the other points to the questions, Nora.
Thank you so much, Laura. Yeah, what I hear very loud and clear is that there's really no way around understanding the context or knowing the risk, as I think you've all said in your remarks. Perhaps, Matthias, I can go back to you if you'd like to comment on that, and perhaps share also from your perspective. We've heard this big do is know the risk, understand the risk. Are there any other sort of do's and don'ts that you think of, given your expertise?
Do's is, I will say, talk to your peers. You're not the only ones facing these problems, and it doesn't matter where you come from, a large or a small financial institution. We're all facing the same problems. So talking to peers is going to help us understand, engage better on this topic. Sometimes the solutions are not depending from one person or from one institution itself. It can be it has to be a systemic approach. And don't do's is basically, let's not ignore this any longer. It is happening. It's not going to happen in the future. It is happening already. And whether we want to accept that these are climate change events that are becoming more and more acute and more extreme or not, events are going to happen anyway. And we need to start thinking of how we can prevent or how we can adapt to what's happening. So let's not continue ignoring the issues, and let's talk more about it more openly so we can find common ground and common solutions.
Absolutely. I think that's the key, really. It doesn't matter if it's a big multinational or a small organization. I think, Verity, you also alluded to that one of the beauties of the ISSB really is that it can be made fit for organizations of any sizes, right? Are there any other kind of best practices or any don'ts that come to mind for you that you'd like to share?
I'd like to stick in the do category too. I think what we have seen across Latin America and the Caribbean is that there's already very strong preparation, and there are already great models to follow within the region. So Matthias's advice to look to peers is a great piece of advice. Our standards specifically do allow companies to use metrics that they see their industry peers are using. You could use those as long as they're also designed for investor communications. That materiality is really important for our information to make sure that allocators are getting the decision useful information in order to assess risk and opportunity and ultimately price assets. I'd say just a couple statistics here. When it comes to industry specific disclosures and using the SASB standards across Latin America and the Caribbean, there's now for the LAC 40, which is an index within the S&P 1200 index, there's 95% of the LAC 40 now disclosing to SASB standards. And we look to the larger group of companies across Latin America and the Caribbean that are already disclosing to SASB standards. We find that it's more than 40% of those companies are small and medium-sized enterprises. So we really have built in proportionate mechanisms to help companies of all sizes be able to produce this information in order to attract capital. And then I'll also say, there's no reason to delay getting started. If there are entities that have not yet begun to disclose to TCFD or SASB, which are the great preparations for the ISSB standards, entities can know that there is some jurisdictional attention coming, some legal mandates coming down the pipe. So we're seeing some jurisdictional interest now. Worldwide, we're seeing interest in ISSB aligned proposals coming from more than 20 jurisdictions around the world. And those jurisdictions represent more than 50% of global GDP, more than 40% of global market capitalization, and that's 75% excluding the US. And that's also representing more than 50% of global greenhouse gas emissions. So the world is looking to align with ISSB standards. And within Latin America and the Caribbean, Brazil has already gone down its legal process, and companies in Brazil will already need to legally begin to disclose to ISSB standards in 2026. But we're also seeing action in Costa Rica and Bolivia, and I hope many other jurisdictions across the region very soon.
So now is really the time to do it. Laura, I think you and Verity both mentioned that it's not just climate, right? It's sustainability as a bigger picture, and you mentioned how climate should not be seen in a vacuum. Could you perhaps go a little bit more into detail on that point? I think that also links to how there's not just an ISSB standard on climate, right, but on sustainability in general.
Sure, Nora. I mean, it's great to start the Sustainability Week with a conversation on climate, and we must embed climate change risk management and opportunities management within the sustainability broader agenda, because ultimately we live and we work and we invest in Latin America, and we must understand that the development deficits experienced in our region, they also enhance climate vulnerabilities. So the success of adaptation and mitigation measures can be threatened by these development deficits, and we must integrate climate change risk management and opportunities investment within a broader agenda that pursues a climate compatible and sustainable development pathway. I'd like to also comment on the question you were making to Matthias and Verity on the do's and don'ts. So definitely do embed climate change risk management within, a broader agenda. But there's a number of don'ts which I seem to be seeing, and it'd be a good time to, break that pattern. The first thing is to not assume it is just extreme events that will affect the portfolio. Actually, gradual changes in climate can lead to persistent and compounding impacts on the financial performance of assets over time. Have a look, for example, at the climate scenario analysis and TCFD-aligned risk disclosures of the Citibank over the past couple of years. They mentioned how in their portfolio, they were comparing short-term impacts and longer-term systemic changes due to climate policies, market shifts, and notice how gradual small events were actually having a compound impact on the portfolio. So don't assume it's just the extreme events. Do not treat climate risk assessments or the framing of climate risk management strategies as just another tick the box exercise. This is not to be pushed to the back office of the ESG representative of the organization to include them, but because of the nature and magnitude, climate risks are to be treated as financial risks. So do raise the topic to the highest level of decision making within the board of directors of the organization. Do start by ensuring governance, buying, and resources are allocated to explore and tackle risks as a matter of strategic business sustainability. And in order to do that, my last point, you must gather the necessary data and information to demonstrate that climate risks are affecting your portfolio and what emerging solutions you should invest in. And I'm 100% sure that you will find information to sustain your case within your organization. A great place to start are, you can go to the latest 3 publications of the UNEP-FI, a program that has been established to catalyze action across the financial system in order to align with sustainable development. And they've just published 3 great publications on physical transition risks and data challenges. Another document to look into is the Common Framework for Sustainable Finance Taxonomies. IDB is part of the working group of the taxonomy, as well as the Adaptation Solutions Taxonomy, which is an initiative by Lightsmith Group with the support of IDB and IDB Lab. So plenty of resources there and plenty of reasons to be working on this journey.
Perhaps on a very related note, we're starting to see a lot of questions in the chat. Thank you so much. And please stay engaged. Please keep posting them. I'm going to try and pick up as many as I can, but very related to the point you just made, Laura. We got one question asking panelists to comment on trends in integration of quantifying financial impact of climate risk. So we've heard a lot of data. The question was posed to you, Laura. So perhaps I'm just gonna bounce it right back to you. But then Verity and Matthias, if you want to chime in there as well, please.
Whenever you get this question, the first thing that comes to mind are the barriers to measuring the impacts. And I think Matthias was talking about this at the beginning. We certainly have data challenges. And part of the reasons why we do is because the climate risk practitioners and the credit risk managers have a completely different understanding of what risk means and what exposure means. We quantify and measure risk according to geography. Depending on where your operation is, that will dictate what exposure do you have to different climate phenomena. Clearly, if you're not in the coastline, you're not exposed to storm surges, or upwelling, coastal inundation or flooding. So to us, it has been one of the greatest challenges is to get to a common understanding of risk and to get financial institutions to start collecting data on the real operations that they invest in and their location. So one key step is to change the way in which you collect data from your clients so that not only you have data on their headquarter location, but you have data on where the operations actually are. Without that, we are working in a vacuum. We can't really tell you what the exposure of your portfolio is if we don't know where the money is being invested in. But there are, I mentioned UNEP-FI, there are other initiatives, UNPR, responsible banking initiatives, many ones that are trying to fill in the gaps so that we can make projections. And critical in this process is scenario analysis. I mentioned how Citibank used it. It's now being used, extensively as best practice by commercial banks and national development banks, because what scenario analysis allows you to do is you may not have full certainty of where we are going, but you could look at different plausible scenarios. And in doing that, you can even integrate, plausible scenarios on transition risks where we really don't know how regulation is going to change, right? So in doing that, you are tackling uncertainty in a robust manner. You're trying to find the best option, the win-win solution under different scenarios. So that's one way to go around. But I would say there is an increasing, movement to work with climate relevant data within financial institutions.
I'd love to tack on to that, Nora, if I may, because Laura lays out so many good ideas. And I think, Laura, your comments especially refer to physical risks when you're referring to geography and operations, and absolutely. And if we think about the additional considerations of how to quantify risks, we can think about not only those physical plants and operations in its specific geography, which of course would be absolutely, the risk would be a function of the location. There's also thinking about the entity's business model and how resilient that is to thinking about transition risk. Is it well placed to weather many storms or only one storm, if you like? And then we could think about the company's or the entity's capacity to respond to some of these shocks and risks. And here's where scenario analysis can really help. So, when a company is able to think through questions like, how would it need to change its business model in order to continue to be successful over the short, medium, and long term? This is starting to begin to generate sort of, how much investment could be required in order to continue to make this a going concern over the long term. Would this company need to upgrade, decommission, or redeploy its assets? This would all require financial effects related to those activities. What plans has the company already undertaken? Has it shorn up its climate resilience to physical climate shocks and already deployed a lot of capital investment? Or does it need to double that capital investment in order to make sure that it's really there? Does it need to move its operations to a different location? And that would entail many other costs associated with hiring new workers and creating new systems to support that market shift. These are huge business decisions that also have implications to the financials. And that's why we also have specific detail about requiring entities to disclose their financial effects, both the current financial effects and their anticipated financial effects related to climate risk. This is something we require in our climate disclosure standard, and we also require for other sustainability related risks and opportunities in our S1 standard. So these current and anticipated financial effects can also be reported in many different ways. Investors are accustomed to hearing sort of directional disclosures from entities. They may not know precisely how much money will be expected to respond to a mega trend or an opportunity that they want to play in, an entirely new area that they might want to, an area of market growth they might want to enter for the first time. So they may have sort of round numbers that they could be able to anticipate. And so that would be a directional, helpful information for investors. Other companies might be able to quantify, especially when you think about the most recent trailing 12 months, precisely how much money they had to spend to respond to climate-related shocks or risks. And so there's quite a range of acceptable and reasonable amounts relating to the financials that can help investors make better decisions.
Any additional thoughts on that, Matthias?
I'm gonna take it down one notch, because Laura and Verity focused a lot on climate scenarios and how this helps investors make and businesses make strategic decisions. But the challenge of information, it's even more simpler than that. We don't have quality of information disclosed by companies, like basic information, right? Companies cannot tell us right now how much they spend on transport, whether it's flying, driving, or boat, on their products or on their people, and therefore we cannot do proper calculations on CO2 emissions from the companies. We don't get good quality information on the amount of, I don't know, pesticides or agrochemicals that agricultural companies or agro industries utilize in order to produce. So the challenge of information is at all levels of the companies and in the economies. And the more companies and the more productive units we have out there providing information, first-hand information, the more we can paint an accurate picture. We might not like the picture that we painted, but the more accurate we can paint this picture. And because of that, the better the measures that we can, the better the measures that we can take are going to be. So I think the challenge of information is precisely that. There's not many companies that are brave enough to put that information out there because they feel exposed, because they feel that they're going to be seen as bad. But we need that information in order to start making those good decisions. So the challenge of information and how we can tackle this, and from this basic information I'm talking how we can scale it up to making the scenarios is incredibly important. It is incredibly important. But yeah, it's I think the challenge is there. There are not enough companies disclosing.
Yeah, very much a case of sometimes letting perfect be the enemy of the good, right? Yeah, that's a great point. I see that there is a lot of interest in IFRS and in the standards. There are a bunch of questions for you, Verity. Perhaps I'm going to try and take a couple of them together, and then you could try and briefly answer them. So one question is, does the IFRS foresee the publication of new standards in addition to the already published IFRS S1 and S2? And then there are a couple of questions that are a bit more specific. One, do US real estate investors with projects in Latin America and the Caribbean have to comply with ISSB S2? And then I think there is a third question asking what happens in the leasing and factoring industry in South America, and must they use S2 as well, and what kind of SASB guidance would apply?
Okay.
Maybe you can take one or a couple of them. Thank you.
Yes, thank you. So first, we have just decided our work plan of work we'll do over the next 2 years. And we included 4 major projects there. One is to support adoption and use of IFRS S1 and IFRS S2, our first 2 standards covering climate and all other sustainability related risks and opportunities. That's what I'm doing here with you today, supporting adoption and use of S1 and S2. We also will be enhancing our SASB standards. While we have a complete set of industry-specific standards for 77 industries, you can download those at sasb.org. They're available for use. They are translated into Spanish since 2018, and we'll be updating those translations this year in Spanish as well. Those industry standards are available for use, but we also know that markets change, business models evolve, and so we want to do more work to make sure that those continue to be fit for purpose and useful to as many companies in as many jurisdictions as possible. And then we're also going to begin research on 2 new project areas. One will be human capital, and this is human capital management, including human rights aspects related to workers and workers in the value chain. And the other area is what we call biodiversity, ecosystems, and ecosystem services, which many of you might just call nature for short. And while there's a lot of overlap with climate, we're going to do some research and find out what could be additional, what could we enhance through industry-specific support, and also how we could help the capital markets really get better information across these themes. So I think I covered the first and third question, and maybe Nora, just another point on the US market. So this question kind of points to both investors in the US and also entities in the US. And one is the ISSB standards are available for investors, lenders, and creditors to use for free anytime in every jurisdiction for any sector. For analyzing entities and making decisions about providing resources to those entities. So any investor anywhere can ask their prospective investee to provide information according to ISSB standards. And in fact, we're hearing many US investors are doing this. 2 quick examples. BlackRock and Vanguard are 2 very large US asset managers. And in their 2024 proxy voting guidelines, both of those firms have asked that companies disclose to ISSB standards. So those are two global investors based in the US who are using ISSB standards. The question was also about entities in the US disclosing to ISSB standards. Well, in the US, you may have heard that the US Securities and Exchange Commission recently issued its own climate disclosure rule, which is now being legally challenged. So it's been paused. If you like, companies are not required to comply with that rule at this time until the legal challenges are settled. But in the meantime, because those investors are asking for information, such as BlackRock, Vanguard, and many, many others, including California State Futures Retirement System and many other asset owners, companies still need to respond to their investors by providing material, decision useful information. So this kind of market adoption, market use is still very much in play and still what we're seeing today and driving company decisions to decide what to disclose.
Thank you very much. And I'm also seeing thankful comments in the chat on your very comprehensive response. I see that we have so many more questions, but we already need to slowly wrap up. So perhaps just bearing in mind that we have more questions on SMEs, small and medium enterprises, and how data gathering can be particularly difficult there, and also questions on what tools we can use. Perhaps in your closing remarks, and if you can keep it to like 45 seconds max, could you share like one last top tip, each of you? Laura, I'll start with you.
I'll start with the SMEs one because my doctoral thesis was called Relational Adaptation, how to help SMEs adapt. So yes, there are information asymmetries, there are production challenges, especially for SMEs in Latin America. I would say the best thing is the way in which you relate as an SMEs with others in your network can help you access the resources, the information required. So always look at relationships as a key to adaptive capacity when you are a small business. I'd also like to say that financial institutions, I believe, can effectively navigate the uncertainties of transitioning to low carbon economy. And I'm just going to give you really quickly 5 ways in which that can be done. First, we mentioned scenario planning. Second, becoming more flexible and adaptable. So embracing dynamic allocation, regularly reviewing and adjusting portfolios to new information and new developments, diversifying the portfolios across sectors and geographies, collaborating with the governments and with industry associations to drive forward the right type of regulations needed. And so you are aware what the regulation is coming, and then investing in training and capacity building. So really allocate time in your diaries to get acquainted with climate risks and opportunities. It's not just a matter of being smart. It is critical business survival. And there's just no space to doubt because we just don't have enough time to hesitate taking action. And there just isn't a more important, more impactful and reasonable thing to invest in.
Great, thank you. Matthias.
Sorry. How to tackle the challenge of information from SMEs and trying to wrap up this in a short way. I think that the answer Lara gave provides the best hint ever. SMEs, even though they're small units, we cannot consider them as standalones and that they're going to do things individually. They need to start working more in a sort of network. And for that, I think that the power of aggregation that banks and financial institutions have is fundamental. The reason why working on sustainability through the financial sector makes sense is because apart from the state, the financial sector is the only private actor that reaches every single part of the economy, right? So if the financial institutions have the capacity and have well-structured mechanisms to request this information, and here a note of caution, financial institutions need to stop being shy to request more information. Even though it's a lot of information being requested already, this is the information that's actually going to help you improve your business, right? Because this information is not about whether you're doing things good or not. It's about how efficient you are using the resources that you need to use. in the end, this all is actually boiling down to how efficient we are using resources. So the power of aggregation of FIs to transmit both the measures that other SMEs are taking in the same area or collecting the information that SMEs are generating, I think is fundamental.
Thank you, Matthias. Very briefly.
Laura and Matthias gave such great answers. I just want to double click there on what Matthias said at the end, is that this is about a dialogue here between entities and their allocators of capital. And in order to have that dialogue, you really have to ask for what you need and what you want. And then companies and entities can respond with the right information, the decision, useful information to support good decisions.
Thank you so much. There's nothing left for me to say other than a big thank you. And if we can project this very quickly on the screen, there will be a QR code. So if you guys can scan this QR code, this is for a short survey of this session. We aim to improve constantly how we do these sessions, how we share knowledge. Thank you so much for everyone who helped set this up, particularly Natalia, Carolina, Valentina, Mauro, Luis. Thank you so much. This is just the beginning of Sustainability Week. We're kicking off today. There are so many more sessions, including on climate change, on financial institutions, but also on completely different topics, on labor standards, on the bioeconomy, but maybe, well, given that climate change touches everything and everyone, maybe not so different after all. So stay tuned, stay engaged, and, well, enjoy Sustainability Week. Have a good day. Bye-bye. Adios.
Thank you.